Hello everyone, let me introduce myself. My name's Fikran Ridho from Class Management 24X. My NPM 244111042. An account in accounting is a record that summarizes all transactions related to a particular item. It tracks increases and decreases in financial elements such as assets, liabilities, equity, revenue, and expenses. Accounts help organize and maintain a systematic record of financial data for easy reference and analysis. 5 types of accounts and their normal balances. 1. Assets. Definition: resources owned by the business that are expected to provide future economic benefits. Example: cash, equipment, inventory. Normal balance: debit. Explanation: asset accounts increase with a debit and decrease with a credit. 2. Liabilities. Definition: obligations or debts owed to outsiders or creditors. Example: accounts payable, loans. Normal balance: credit. Explanation: liability accounts increase with a credit and decrease with a debit. 3. Equity. Definition: the owner's interest or residual value in the business after liabilities are deducted from assets. Example: common stock, retained earnings. Normal balance: credit. Explanation: equity accounts increase with a credit and decrease with a debit. 4. Revenue. Definition: income generated from the business's operations. Example: sales, service fees. Normal balance: credit. Explanation: revenue accounts increase with a credit and decrease with a debit. 5. Expenses. Definition: costs incurred by the business to generate revenue. Example: rent, utilities, salaries. Normal balance: debit. Explanation: expense accounts increase with a debit and decrease with a credit. Inputting transactions into a general journal. The general journal is a chronological record of all financial transactions in the form of journal entries. Each entry includes date of the transaction, accounts affected, amounts debited and credited, a brief description of the transaction. The journal entry format follows the double-entry accounting system where every transaction affects at least 2 accounts. One account is debited and the other is credited. Steps to input a transaction. 1. Determine accounts affected. Identify which accounts are impacted by the transaction. 2. Determine increase or decrease. Determine if each account will increase or decrease. 3. Apply normal balances. Based on the type of account, decide whether to record the transaction as a debit or a credit. 4. Record the entry. Write the date of the transaction. List the debit accounts first with the debit amount in the left column. List the credit accounts next with the credit amount in the right column, indented to show that it's a credit. Include a brief description. Example journal entry. Transaction: the business buys equipment for $5,000 in cash. Date: account debit credit. The 7th of November 2024. Equipment $5,000. Cash $5,000. Purchased equipment with cash. In this example, equipment, asset, is debited, increasing the asset. Cash, asset, is credited, decreasing the cash account. This maintains the accounting equation by balancing the entries and accurately recording the transaction. That's all the explanation from me. Thank you for watching this video until the end.